All right, all right, all right. I think we may have it back, guys. Let me know if you can hear me. Yeah, we got it. We got it. I'm seeing myself on screen. All right. Sorry about that, guys. Zoom died right in the middle of the video, and that's why we're having issues. Hopefully you guys can hear me, and we are back in the live stream. We'll let it load again, and then we'll get into our subject. Sometimes technology is our biggest drawback in today's society. All right, it says Robert, nice to hear you properly. We got it. We got it now. No, I'm not being hacked. It's Zoom. Zoom went through some recent updates and we've been having troubles with it. We use it as our primary broadcasting software, but I've noticed that it has some issues, and I think that's just the growth in Zoom and the demand upon their servers. So we're looking into alternatives. So we'll come up with some good alternatives so we move past Zoom, because really, honestly, it's not the best software to do this, but it looks like we are back. So I'm going to get right back to the program and get into the topic, which is monetary velocity and how it's going to cause rampant inflation. So we will get into this share for you guys right now. So going back to the article in USC Economics Review, we're going to define what is monetary velocity, and then we're going to talk about it for the rest of this broadcast. And then we're going to go answer your questions. So if you guys have questions, put them down in the chat. And do super chats if you really want to get my attention, and I will answer those for you. All right, we're going to get into the boring academic definition of what is money velocity. It is calculated on a quarterly basis, and it is a function of calculating the ratio of gross domestic product to the domestic money supply, V equals PQ over M. Now, I will say that this is really a silly formula. It doesn't really prove anything, but since it's something that we use to measure how many times money is being spent in the economy, i.e., what the inflation may be like, we're going to talk about it. So in simpler terms, it's a measure of the frequency in which one unit of currency or money is used in transactions or purchased domestically made goods or services. Money velocity is constantly changing, blah, 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 and changes to money velocity infer two main possibilities: how quickly the economy as a whole is growing or shrinking, and the rate at which money supply is increasing or decreasing. As a result, the velocity of money aids economists in predicting the overall strength of the economy. That's what the egghead academics say, although I have to basically argue with that. Monetary velocity is basically how many times you're spending money on goods. It does not discount the amount of money in society. So if you have X amount of goods and the money supply goes up, you do not have to have heavy monetary velocity to bid up the prices of those goods. In other words, you can have inflation without heavy monetary velocity, contrary to what most Keynesian economists will tell you. But the monetary velocity tells you how quickly people are spending the money that they have. So in the example of bank reserves, if monetary velocity is down and they're just being held on the bank's balance sheets, that's less money circulating. So monetary velocity can tell you how much of the circulating money supply is being spent. Now, if that ticks up, what it means more than likely is you're going to have some issues with inflation, because it means people are spending more of their money more quickly. So here we have M1 money supply according to Fred. And you can see that it spiked last year because of the pandemic, went from about 4 trillion to about 20 trillion. So it multiplied by a factor of 5. M1 is a more liquid measure of monetary supply. And if we look at the velocity of M1 money stock in the US, it's gone down back to last year. So last year, it's gone down from about 1.23 to 1.17, not much, but it stayed basically flat, in other words. M2 money supply includes some other things. So let's define M2. It's money market accounts, savings deposits. I'm reading right here. M2 consists of M1 plus. You add in savings deposits, money market accounts, small denomination time deposits, less individual IRA and Keogh balance accounts, balances in retail money market funds. In other words, you just add more different types of money in the system. And you can see that that expanded. In 2020, it went up from about 16 to about 22 trillion. So it went up quite a bit, but not quite as much, because what the Fed had printed was the more liquid electronic and paper money supply. So that makes a lot of sense. So I'm going to stop right now, see how you guys are doing in chat. Appreciate you guys being on here. Sorry for the technical problems. To reset, we're talking about the monetary supply and how that's going to lead to much higher inflation. That's the subject of this broadcast. We're going to provide you a lot of data around that. Again, this is the Cowboys Mills live stream where we broadcast from the great state of Texas, and we take no bullshit. And we're doing this about a week before Thanksgiving because I thought it was time for a good research piece. If you watch the pieces we've had the last 2 days, we've talked more at a high level about things you can do to help your investments. and to invest during times of shortages. But I think today it's better for us to do a research piece here. Thank you everybody for joining. We got Kevin W. Neil Hahn is in the house. Great Nate is in. Jack Daniel is in. Flame Tongu is in. Kevin W. is in. Robert Dentler, Cheshire Yeoman, and many others. Neil Hahn is back in. John Hopkins and Raymond Chalmers. Thank you everybody for joining the program. Sorry for the technical issues, but we're into it now. So let's go back to monetary velocity. When we talk about monetary velocity, we're talking about how quickly money turns over, which is one of the two measures you can use to measure whether we're going to have an increase in prices. So the monetary velocity for M2 has fallen quite a bit since 2000, meaning we printed a bunch of money, but people were spending it less. So the question is, if the velocity of money is down right now, how can that lead to higher inflation? Well, it's the base effect, because you can see in the velocity of money M1 here and M2 here, the broader measure, they're down, which offers the opportunity that if that monetary velocity speeds up and the amount of money circulating through the system per the amount of goods speeds up, we're going to have rapidly rising inflation, right? Aha. So you get the punchline of the story, which is, guess what? Monetary velocity is ticking up. So how do we know monetary velocity is ticking up? Well, here from a Zero Hedge article from Knowledge Leaders Capital is a chart of U.S. commercial bank credit. You can see in 2021 that the banks had a lot of additional credit that's available monetary supply, because in the banking system, credit is money. So they have a lot of money in the system. They're flush with it, tons of it. I believe this is $10 trillion. I don't have the actual measure, but it's gone up quite a bit. It's gone up a lot this year. And when we look at the bank loans, they're taking it in, but unlike past years since 2008, they're not holding it. You can see that bank asset loans and leases in the consumer sector, credit cards, and residential commercial loans has ticked up, and industrial has ticked up a little, but it's ticked up a lot in consumer credit cards and mortgages, meaning the banks are, let's translate this to plain English, the banks are pushing money out. Okay. And as they push that money out, it's driving up paper asset prices. It's going to drive up the stock markets. It's driving up real estate prices. Consumers are taking on more credit so that they have less available cash basically to pay bills every month, because they're servicing all that credit, right? Consumers become less liquid. They think that they're doing okay because the stock and house prices are going up, but that's just fiat inflation. That's not real value, okay, over time. So it looks as though that money that's been in the system the last 12 years, not only the M1 and M2 printed last year, and the 40% of M1 ever created was printed last year. I've said that many times, but also a lot of the pent up bank reserves dating back to the financial crisis, 2008, 2009, when they started their quantitative easing and printing programs. That's also being pushed from the banks into the consumer end of the sector through these loans and through these programs. So what does that mean? Well, it means we're having inflation. We know that we're having higher prices. We talked about the CPI going up. That's the consumer price index. That's the end prices you pay. Talked about the producer prices going up, which gets funneled on down to the consumers. And we talked about commodity prices going up, which is the raw inputs we use on all our goods and services, right? Plus we know labor costs are going up. All of it's going up. This is why all that money that was sitting at the banks, for all those years that they were using to capitalize their banks, is now being pushed out. They're looking for return. They're pushing that money out, trying to get the consumers to basically take on that debt and provide that interest. That puts the consumers at risk. That means we're not going to have a consumer-led recovery. All right. Now an article from Stuart Alsop at Seeking Alpha, the magazine I wrote at for many years. Hyperinflation risks are rising. This is dated October 31st, not long ago. His summary points are: the risk of a further surge in inflation is rising as U.S. policymakers continue to increase spending while failing to connect the dots between their policies and rising risk pressures. What did we just say? All that spending is coming first through the commercial banks and then out into the economy. That's why we have rising prices. If it becomes clear among the public that policymakers will run large fiscal deficits indefinitely and print the difference, a collapse in demand for money cannot be ruled out. That would be a collapse in the system, which would be a hyperinflation. Not a big inflation, but a hyperinflation. Precious metals offer a low cost call option on worst case scenario, meaning they're your hedge, if you want to translate that into English, or your protection. The combination of debt monetization and lack of understanding of economics and general population of policymakers has resulted in a surge in demand for government spending. Some more spending gets pushed out through the system. That's the way that goes. Rising gold and silver prices potential further encourage a rise in monetary velocity as they signal to the public that inflation is likely to rise further. So in other words, as gold and silver rise, people get the story that there's panic or risk in the system, that prices are rising, and that further fuels monetary velocity. Okay, that's the issue. And he's got a picture of a burning dollar, good picture there. So I'm going to go down to a quote, which he has. Well, I'm going to go down to a chart first. This is U.S. fiscal deficit percent of GDP. So look at this number spike up. That the deficit is what we spend on a yearly basis, and he's comparing it to gross domestic product. So this has ticked up the most dating back to, God, 1960. Look at this number spike, almost 50% over what it was before. So the deficit itself is rising, but the yearly deficit that we have, that we're spending too much, is rising so much that that's where this influx of money came from. Okay, so all that monetary aggregate that you see here on this M2 chart and this M1 chart, all of this is basically in this chart here. Okay, they printed the money, they took on the debt, and they actually didn't print enough money to pay for everything that they're taking on. That's why you have the deficits. All those things are occurring at the same time. But he's got a nice quote here from Mises. And Mises is one of the Austrian economists. And I'm going to read this to you because it explains what's likely to happen as a result of all this other stuff. If once public opinion, and I'm reading right here, returning to Mises, these three paragraphs, if once public opinion is convinced that the increase in the quantity of money will continue and never come to an end, I'd say we're safely there as a society. And that consequently, the prices of all commodities and services will not cease to rise. Okay, I think we're there too. Everybody then becomes eager to buy as much as possible and to restrict his cash holding to a minimum size, meaning he's going to spend it and get it out of his bank account. What's that? That's monetary velocity increasing. For under these circumstances, the regular costs incurred by holding cash are increased by the losses caused by the progressive fall in purchasing power. Okay, translated, if you hold the money and it's devaluing quickly, you can buy less. So you're going to want to spend it now. Spend it now while it still has value. The advantages of holding cash must be paid for by the sacrifices which are deemed unreasonably burdensome. This phenomenon was in the European inflations in the 20s, talking about the 1920s, called flight into real goods. In other words, this has happened before the Great Depression. Pay attention. The mathematical economists are at a loss to comprehend the causal relationship between the increase in quantity of money and what they call velocity of circulation. In other words, a lot of the Keynesians will say velocity of circulation is the only cause of inflation. What Mises is going to say, no, that's a measure of how quickly people are spending as a result of the panic. It is not, however, the cause of inflation. The cause of inflation is how much the monetary supply rises above the GDP, the total product, gross domestic product. When you have more money chasing less actual production, prices must rise to equalize. That's natural supply and demand. So what he's saying here is the velocity of money is not what causes inflation. It's signaling the panic about the existing inflation. Okay, so as that monetary velocity rises, the closer we are to the hyperinflationary event. In other words, hence the title of this video. The characteristic mark of the phenomenon is that the increase, and I'm here in this paragraph, in the quantity of money causes a fall in the demand for money. The tendency toward a fall in purchasing power as generated by the increased supply of money is intensified by the general propensity to restrict cash holdings, which it brings about. Eventually, a point is reached where the price at which people would be prepared to part with real goods discount to such an extent the expected progress in the fall of purchasing power that nobody has a sufficient amount of cash in hand to pay them. In other words, hyperinflation. The monetary value decreases so quickly that people then have a confidence event, lose confidence in the money, shove it all out the door, and to which point that when you try to get physical goods, no amount of money will buy it. That's what that paragraph says. That is the crack up boom and then the hyperinflation. That's what we're seeing with an increase in the velocity of money. Okay, how do we know the velocity of money is going to tick up? Because we see that the velocity of money is ticking up in the banking system. The commercial loans, the mortgages, the consumer, which is 72% of the economy, has now gotten hold of those bank reserves we've been holding for 10 to 12 years, including last year. And the banks are pushing it out and the consumers are spending. So now we're in the high inflation part of the death of the dollar. That won't be hyperinflation. Hyperinflation is not just that we have all the money in circulation. It's when people figure out we have money, that the velocity of money ticks up. They try to get rid of it. And as it ticks up, it leads to a loss of confidence, which leads to hyperinflation. Okay, that's essentially what's happening. We're in the stage in which we already have the high inflation due to the monetary aggregates, the M1 and M2, being increased much faster than our production. So the inflation is now in the system. People have noticed the inflation. Sally Homemaker knows about the inflation. Bob, the businessman, knows about the inflation. They're trying to get rid of their cash to buy goods or to spur business as fast as they can. That's why velocity money has ticked up. You're going to start to see the velocity money measures tick up. Now, the Keynesian economists are going to say, well, it's the velocity of money which caused the problem. It's not. It's the amount of money that was printed in the first place. The velocity money is what's telling you that people are panicking about the existing inflation. So when you had a 6.2 inflation print for October, which came out a few days ago, the first week of November, that tells people there's high inflation. And it's been high dating back to March, April. So people know inflation's coming. They're getting rid of their dollars. They're spending more dollars. That's velocity of money. But the dollars were already printed. That's what causes the loss in confidence of the monetary system. So that's a little lesson for you that we're getting closer to the break of the dollar. Now, is it going to happen tomorrow? No. It's going to take time for that velocity of money to continue to tick up and eventually for that to reach mainstream economic channels and for people to really go into a panic, a loss of confidence. I think it's going to take a while. But I wanted to bring this to you as soon as I saw it. As soon as I see the velocity money start to tick up, those loans coming through the system, the banks pushing out the money. The banks are pushing out the money because they're smart and they know inflation is coming. So they push it out to get rid of it, to get some return on their loans or to invest in businesses because they know cash is devaluing. Then the people get it, and inflation goes up, and then they know, and then they push it, and everybody pushes it, but nobody wants it, right? Nobody wants the devaluing dollar. Everybody's pushing it. And it's when everybody's pushing at the same time, but nobody's pulling, nobody's taking it back, is when you have the loss of confidence, and then it just goes bam, like that. And the whole thing collapses like a house of cards. But the printing has been going on basically since 1913, and especially the last 12 years since the financial crisis. That's what led up to what we're seeing now. So I think I've explained that pretty well. If you guys have questions, let me know. Thank you everybody for joining the program. 133 in. Sorry that we had an issue with the very first live stream. Zoom, which is our software, crashed on us. We're looking for alternative software, but we got it back up. Thank you everybody for coming into the new stream. This session is called Monetary Velocity is basically kicking up, and so too will inflation, and eventually it will lead to a hyperinflation. And that's what's going on right now. We're entering the crack up, the early stages of the crack up boom phase that Austrian economists will tell you about. And then comes the deflationary collapse and then the hyperinflation of the currency. That's what's happened in the past. That's what we think is going to happen this time. This is where we are. And I keep saying we're in the 11th hour. Yes, we're in the 11th hour. It's not going to take long. Welcome to Cowboys Metals live stream for Thursday, November 18th, 2021. Where we broadcast from the great state of Texas and we take no bullshit. Cool Breeze, thank you for joining. Steve, we appreciate you being here. Thank you everybody for being here. Cheshire Yeoman for joining us, Kevin W, Dennis Bow, John Hopkins. If you guys have questions, throw them in there. This is a Q&A live stream session. If you got questions, we got answers, or at least we'll try to get you answers. Bring it to Super Chat, bring it to the chat, and we'll answer the best that we can. Dennis Bow says today is a lunar eclipse. If you're into the moon cycles, that could be very, very important for you. The eclipses and the brand new moons are always very important. Rolf Steiner says Texas can join Mexico. Well, we can, but I would rather Texas be independent and be its own country again. If we're gonna, leave the United States, let's be our own country. Dennis Bow says this is a war between peoples and elite, not nations to nation drama. I agree, but they push it out as nation and nation drama to get you to fight with each other. But you got to see who's causing, who are the real antagonists here. And it's not the nation states or even some of the stupid politicians. It is the elites running the banking system. I agree with you very much. With JAG Prototype says, with new lockdowns around the world, slowly the velocity the banks are spending to buy assets, not lending. We're not seeing hyperinflation because the supply chains are not operational. I would say yes and no. The banks are pushing it out to consumers. I did show that chart. I could show it again, but they're pushing out consumers. They're not just buying assets. They're pushing out loans. So that chart I showed you from Zero Hedge says they're clearly pushing into loans, which is going to consumers. That's not assets, that's lending. That lending has ticked up in consumer, mortgage, and somewhat in industrial. And that's why I believe the monetary velocity is going to increase, but we're going to follow it. Good comment there. Thank you. When is the next silver leg up? Well, we're holding right now 24.50, which is a critical price level. I think we're at 24.80 the last time I looked. So we're barely above that. If we can continue to hold that, we're in the next upcycle. That being said, I think gold's going to have to break 2000 before silver just rockets. Because why? Because we had gold 2000 last year. So gold's going to have to break 2000 and stay there. And then I think you're going to see silver's next leg up. That's my thought. Anyway, if you guys have other thoughts, definitely let me know. I would absolutely love to hear them. So I'm going to take a moment and talk about a company that we have been following while we wait on your guys' questions. So let's talk about 𝙂𝙊𝙇𝘿. The reason I'm talking about 𝙂𝙊𝙇𝘿 because it's something that I track for our mining stock Patreons, 𝙂𝙊𝙇𝘿, and I'm going to be actually adding them to our mining matrix here in the next week. 𝙂𝙊𝙇𝘿 does mining of gold in Colombia. They have a really good project, and they have a news announcement that they are now doing new drilling on the brownfield and recuperation of the Aurora mine. The Aurora mine's their big mine, and we say they're drilling the brownfield. They're drilling where there's been previous production because they know it's there. They just want to find and expand that resource. So the company has 5 gold veins in the area, 3 vein inlets, the 𝙄𝙊𝙇𝙊𝙒 vein. The first target has projected extension of 400 meters, and you've had samples, rock channel samples of 42.3 grams per ton gold and 49.6 grams per ton silver. That's pretty good. Here is the project if you want to take a look at it in the nice pretty map with all of the veins. You can see they have quite a bit of them there, and you can read more here in the release. They're also preparing tunnels for production. So they're going to go back to Aurora, the existing mine. They're going to prepare it for production, continue to drill it out, and then they're going to go into their production. So that is the updated note from 𝙂𝙊. For those of you who follow our mining stocks Mondays and are supporting us on Patreon at the mining tier, we definitely do appreciate it. Questions. I am looking for questions, guys. I don't see a lot of questions. I do see a lot of comments. America is strong. The lions are just quiet, not dead, never be fooled. I agree with you, Neil Hahn. We are all lions that just need to wake up. And a lot of people don't realize they're lions. This is an important part of what I talked about the other day. If you're going to invest and be successful, be your own lion. Don't listen to anybody else. I think Gregory Mannarino calls his followers lions all the time. And what he's trying to do there, guys, is tell you guys that you have the power. You have the power to determine your future politically, economically, and any which way that you want to. You just have to take that power. And I agree with Mr. Mannarino. Silver will be smashed down again next week. Bickericum says in time for Black Friday and Cyber Monday. Could be. I'm not sure if Black Friday has anything to do with it, but I do think that there are regular price smashes, although you could be completely right. I mean, that's a good thought. Harsh Aurora says, is it true that we would be facing depression and hyperinflation together? Yeah, so a deflationary depression and hyperinflation are 2 sides of the same coin. So inflation is different than hyperinflation. Inflation is just a rise in prices. We get that now. You generally tend to get that before the depression. Then you get the deflationary collapse because people can't afford their spending habits. They're taking too much loan. They're levered up. The government's levered up. Companies are levered up. People are levered up, and the whole thing has to collapse. You can't sustain that fake prosperity any longer. When that collapses, the central bank then goes into hyperinflation because they print the last salvo of money. People have suffered inflation so long, they know the money's not worthwhile. You have the crack up boom and the deflationary collapse, and then that leads to hyperinflation. At least that's the typical course of events. We'll have to see what happens here. Michael Sarah says, question, how are you, Rob? So, well, I'm doing good, Michael. Thanks for asking. I appreciate that question. I'm doing great. I've had a great week. You know, we're at Market Disruptors conference in Miami last week. I hung out with Ninja and Financial Fitness, Economic Ninja and Financial Fitness. We had dinner at a place called Barton G, which is totally off the chain. The restaurant was crazy. Had a great time. I spent a couple of days there. I talked to anybody there that wanted to talk precious metals. I talked to some Bitcoin guys there. I'm going to do a special video on what I learned about Bitcoin. I'm not sure it convinced me of anything, but you know, there are some very enthusiastic people in there, and I talked to some good guys. So we'll talk about that. And there's some other stuff we got from Market Disruptors. So that was fun. But overall, I'm enjoying it. I'm getting prepared for Thanksgiving. We're going to have a really fun Thanksgiving. Actually, right after I get off this video, my son and I are going to be going to Ghostbusters, the new Ghostbusters movie. I'm so excited. Ghostbusters is a movie I grew up with. It was a lot of fun with, you know, all the guys that were in it, Annie Potts and all those guys in those movies when we're growing up. I love the Ghostbusters films, and they've come out with what I think is a youthful version of Ghostbusters. I think it's going to be great for the millennials and great for us. My son and I are going to enjoy that together. So we are doing very well. Raymond Chamas, $10 contribution. Thank you so much, sir. Says, Robert, how do you think the actual amount of physical dollars will play into hyperinflation thesis panic? Wild card. There are limitations on spending with debit cards. I experienced this recently. So Raymond, the debit cards will get you access to basically banks' electronic money. So as long as they have enough electronic money on their balance sheet, you should be okay. Although they will put restrictions on it to stave off the banks running out of reserves, capital reserves, they're going to put limitations on debit card spending, withdrawals from your checking account, stuff like that. That's not going to stop the panic. However, they're going to have bank runs at one point and a bank holiday at one point. It's not going to stop it though. The genie's out of the bottle, the cat's out of the bag. That is what it is. But the amount of physical dollars leads to the collapse event, the hyperinflation. Hyperinflation is a confidence event, not just a printing event. The printing event has to precede the confidence event. It's what causes the confidence event when the printing leads to actual inflation we're seeing now. So that leads to the hyperinflation. That's how that works. Dominant Media, I'm moving to Arizona next year. Any conferences you got there next year, I'll show up in my shower curtain and crown, just let security know. I don't know if we have anything out in Arizona, but Phoenix would be a nice little place to do it. Maybe I'll ask Lynette Zhang, who's out there in Phoenix with ITM Trading, if she wants to do something, and we'll do something out there by you. Tell us where you're moving to in Arizona. Maybe we'll come to a town near you. Thank you guys for the contributions on the super chats. We appreciate all of them. Let's see if we have some additional questions there in the chat. I have a question or a comment from John Hopkins. The feds will collapse with the dollar and the chaos states will close borders. And in the chaos states will close borders. That could be entirely true. They could close the borders. But you know, if we have a collapse in the US, people may be fleeing the opposite direction. Anyway, if you came here for economic prosperity to the States and we're not having economic prosperity, they may go back home. We'll have to see what happens. John Dunn says, is it velocity or higher prices for the increase in consumer spending this month or last? So the velocity is just now ticking up. So the inflation occurs first. The velocity ticks up when people want to get rid of dollars when you're going into that hyperinflation scenario. Henry Pham, what are your thoughts on Black Friday spending this year from the context of money velocity? I do think there's going to be a lot of spending. A lot of it will actually be on credit. So it's going to be on increasing credit, not just spending cash, whatever form of money you have, whether cash or electronic money. So I do think it's going to cause people to be more indebted. I'm expecting to have a relatively tame Black Friday and tame holiday season. That doesn't mean that the overall spend won't go up, but it's going to be because of higher prices. But I think the actual physical units of goods moved will be less. I think if we have more Black Friday spending and more holiday spending this year, it's going to be because of inflation, not necessarily because people are able to buy more stuff. It's kind of like looking at movie tickets as an example. If you're talking about the most popular movies of all time, you have to look at people attended, not cost of tickets. Because if you look at tickets now, they could be, $8, $10, $12, depending on where you are and what type of presentation you go to, IMAX versus regular, 3D, whatever the case may be. But back when it was 50 cents for a movie ticket, obviously it's a lot less. So you have to look at the total cost and then the total amount, and that's what's going to tell you. Glendale, Arizona, right next to Phoenix. Thank you, Dumb Money Media. Hey, maybe we'll do something in Phoenix. I'll have to run that by my team and see what they say. Oh, let's see if we have other questions in the chat, guys. Throw them down there. What's your sense of how many shorts left to close for Basel? How many shorts left to close? Let me see if I can interpret that question, Anzi. And shorts on the COMEX. In January, I'm not convinced that everything blows up. I think the LBMA is going to try to weasel their way out of it. I do think it's going to be a big event. I'm unlike Alisdair MacLeod. I'm a little bit different. There is arbitrage going on between COMEX and the London OTC. So yes, some of the shorts will have to close on COMEX. It's not all the arbitrage between London and the COMEX. I think some of the shorts are going to exist. Some of the big bullion banks have already got out of their long short position. Some of them haven't. We'll have to see what happens to them, but I'm not convinced the whole COMEX collapses on January 1st, 2022, when Basel III comes into effect in London, because they decided to put it off. But we'll have to see what happens. We'll have to see how big that event is. There's going to be a little stick of TNT, or is it going to be one of those big mama bombs that the army drops? Let's see. Movies are $16 plus in Columbus, Ohio. I totally believe it. They get very expensive. I'll tell you what, on the movies too, we'll walk into movie theaters now. Like we walked in to watch a movie. Well, I walked in to watch Dune one day, and this is in the middle of a Friday or Saturday. I don't remember. Popular time for movies. Watching Dune, new release, had just been out a day or two. And I walk into the Dolby Digital Theater, and I'm the only one in the theater. And then eventually another guy walks in, 2 people in a theater of about 500 people. And the movies have just not recovered where I'm at in Dallas-Fort Worth. They didn't recover in Albuquerque, New Mexico. I was out there for a while too. I didn't see them recover. Haven't seen them recover in Houston. So at least in this South Central part of the country, they haven't recovered. What about where you are? Have the movies recovered? Are people going back, or are they just watching movies at home? I like your hat, says Silver Johnson. Thank you very much, sir. We bought this not too long ago to go with my boots. I do love my cowboy hats. I also have a white one, more of a traditional white straw hat, which I like. This is a black felt. And then I have a hat I got in, Cancun, Mexico. That's more of a Mexican style straw hat, which I like a lot. When I'm out mowing the lawn or whatever, I'll wear that one. That's my go-to for doing yard work. But I do love the hats, and I do appreciate wearing them and being a part of cowboy culture here in Texas, which is still alive and well, contrary to what you may think. Let's see. What do you think of Prospect Ridge mining? Tom Stencil, Prospect Ridge mining. So yes, I have been offered the opportunity to do a profile on Prospect Ridge mining. We're going to do it after Thanksgiving. So Tom, if you want to know what I think about Prospect Ridge mining, stay tuned. The Monday after Thanksgiving, we're going to talk about that. That's going to be on the program. I won't give away the story on that one. I won't bury the lead on that one, but just stay tuned the Monday after Thanksgiving now, and I'll tell you, Tom, about that. Are we lost to mandate? If you're talking about vaccine mandate, I don't know if we're lost to it. I think the second appeals court, which overturned the president's executive order or said basically it's not constitutional. I think that's going to go to the Supreme Court. So I don't think we know if we're lost on anything until the Supreme Court rules. And that may be 5 to 6 months from now. We'll have to see. Let's see what other questions you guys have. Nick Collishaw says, still not convinced LBMA won't have found a way to circumvent Basel regs if they haven't already. I think they bought themselves time to do exactly that. That's what I think. Or maybe the banks to get out of some of their derivative positions. I think that's what that was. So that may be a good comment, Nick. We'll see. What is your, Raymond Chama says, what is your impression, thoughts on mainstream financial news media? Well, that's a good question. You know, years ago, I was involved in the financial industry as an auditor doing some work there. And then to learn more about finance, because I grew up without a father and didn't have somebody to teach me that. My mother was wonderful, but she just didn't understand finance. She grew up in Depression era America. I mean, she just they never had any money. Yeah, I went and got a bunch of licenses, Series 3, 63, 6, and 7. So insurance, commodities, stock, that kind of stuff. And I worked for a couple of companies that did some work, financial services company, Forex company. And I got a lot involved in the mainstream media. And I think, you know, that's there to take your money. That my impression of mainstream media is there to convince you that they should be the experts and you should give up your money and do whatever they say, but I think it's going to keep you poor. And that was actually the subject of one of my recent videos. In fact, I'll give you the name of that video here in a moment. Let me pull up the channel that I just did. It was either last night or the night before. I talked about how to earn your financial freedom and the best way to do that. And it was how to manage your investments to reach your financial freedom. And that was a day ago, we talked about that, or 2 days ago, we talked about that. Go back and watch that video and you'll really get my impression of the financial media. I don't have a super high impression of them or financial advisors. Not that all financial advisors are bad. They're just taught by people whose sole objective is to take your money and use it to get higher gains out of you. That's essentially what I think of it. Renters don't get mineral rights. Good comment. How high will the USD index go? I think there's going to be a melt up in the USD because as people panic due to inflation in other currencies, like for example, in China, we saw 13.5% PPI, producer price index, which means in a month or two, we're going to see it in Chinese consumer prices. Okay. So you're going to see panic in some of the other currencies aren't world reserve. Eventually the dollar will fail. It may be the last one to fail. It's going to be a number of years before it does, I believe. But I think the US index is going to melt up because of that, because it is the best of the horrible options that you have in currencies. And so it's going to melt up first before it flips over and crashes. I think that's what's going to happen. I think you had a second part to that question. Let me see if I can scroll up and get it. Actually, I don't see that question. I lost you, but I think it answered your USDX question. Oh, here we go. When will the USD collapse? Will it be after Euro? Yeah, I think I answered those questions. I think the US is the last to collapse, but I think it will. Let's see what other questions you have. M1 and M2 no longer track. Fed just creating currency at will. Yeah, they did change how they track it. They did announce they're not really tracking it per their historic measurement. So anything they put out has to be suspect. But I do believe them when they say that M1 and M2 has increased greatly in the last 2 years. I do agree that. Trent Stapp says, has there been any more news on U.S. stock exchange moving to Texas? You know, I'm going to save that question for gold, silver, Bitcoin. So there is a interview I did on goldsilverbitcoin.com. So I'm going to actually share it for you guys. So I did this interview today. It should be posted within the next few days. It's going to be on this website, goldsilverbitcoin.com, where I talked with the gentleman that hosts this, Justin, about my view on the first question he asked me was about Texas, the financial center, gold, all that kind of stuff. I talk about it there. So go to goldsilverbitcoin.com. The podcast, it's not out quite yet, but it should be out in the next couple of days, where we talk about the very subject. I'm going to just let you mosey on over there to do it, because I really spent a lot of time explaining it over there. And I think it'd be helpful if you heard it in the context of that interview, and it'll be free for you. It won't cost you anything. So good question. What percent Emarovo become real comptroller? I'm not sure about that, because there was an article out on Zero Hedge today about how she shoplifted in 1995, admitted to it, and basically went to jail. So she has a little bit of a criminal history. I don't know if that'll stop her from getting confirmed, but I think people are looking at her like, not only your policies a little on the outside, but you have a little bit of criminal history. Do we trust that person to be comptroller in the government? I don't really know. Should we need a global gathering party when silver is free? That would be awesome. But we have to do it virtually if it's global, but maybe we can all get together, you know, and hang out in a couple of main cities around the world. Maybe Tokyo, Japan, maybe Moscow, you know, maybe we'll do Dallas, Fort Worth here in the United States, maybe New York, maybe LA, maybe go to the beaches. That might be fun. I do think that we should have some sort of party when silver gets free. I think we should all party in the streets, and we should all get together and rejoice when that happens. Hopefully that happens sooner rather than later. This has been Cowboys Mills live stream. Thank you, everybody, for dealing with the technical problems we have had today. This is the dollar monetary velocity is going to increase and cause massive inflation, which will eventually lead to hyperinflation as people panic. That's the subject of today's video. Thank you, everybody, for joining. And we got almost 200 concurrent users. Been great to have you guys in here. Thank you for putting up with the technical issues we had with Zoom. I think we have gotten through those. We've answered most of the questions. Thank you, Raymond and Dumb Money Media, for the contributions you made in the super chats. Appreciate you guys. I think that may do it for tonight, guys. I see all the questions have been answered. I think we covered the topic with the research. If you're new to this and you haven't seen the whole live stream, go back and rewatch it again, and you will get the sources that I used to talk about velocity of money, hyperinflation, the crack up boom, Austrian economics, and how that all is going to happen. I think it's going to be a very instructive video for you guys. And even though it's a live stream, I think this one has a lot of replayability value, because we're talking about a topic that is going to become very in the forefront over the next couple of years. And that's why I wanted to bring the topic to you. As soon as I saw what's happening to the monetary velocity, the lending from the banks going out and being pushed into the market, and we know that monetary velocity is going to go up, and all that aggregate of money that they've been printing is going to start sloshing around and causing massive inflation and a loss of currency event. The day that I saw that, I wanted to bring this to you guys. I literally said, let's change program. I told my team today, we're changing program for today. I'm doing a live stream, 5 p.m. I found something I got to talk to right now. So that's what you're going to get here. When we find something that is a warning signal, a canary in the coal mine, we're going to do it immediately. I'm going to bring this to you guys. Okay. So I want you guys in early on this. I want you to know it's not going to happen tomorrow, but we're in that final stage of the monetary blow up of the US dollar. It is going to come. Cuckoo 69 says, as a numismatic collector in Canada, I loved your interview video today. Thank you so much. I appreciate that. We did have a numismatic video out today. Did it premiere last night or today? It might have premiered last night, but in any case, yeah, we're going to cover numismatics. The collector coins are of great value when the bullion is in short supply. They're still of great value when bullion is in a lot of supply, and they tend to do very well. The prices tend to fluctuate a little bit less than bullion over time, but they have collector's value, and they signify the history of the United States. The history of gold as money, and even history of gold as money and silver as money throughout the world. We appreciate that. And it's a collector's item, much like a collector's car, a piece of artwork. They have a special place, and they have a unique value proposition. So we're going to talk more about that in the market as we go forward. So appreciate you liking that video, and I'm glad you like the content. We will do more of that. I had this conversation with my social media manager today, and she was like, and I said, well, that video is doing pretty well, but is it hit our core audience? And she said, you know what? A lot of people like it. So I agree with her. Even though everybody's not in numismatics, I think we're going to keep doing that content. In fact, I hear whispers that there may be a numismatic video coming Sunday. I don't know. You guys will have to check it out if you like the numismatics. All right, guys, I think this is going to do it. Yes, rocking the cowboy hat. That's right, because this is Cowboys Metals Live. We're broadcasting from the great state of Texas, and take no bullshit. Thank you guys so much for joining the stream. This is going to do it. Stay tuned. We're not done. We got more content. We'll keep throwing content your way. We've got several more pieces coming before Thanksgiving. you guys stay tuned to the channel. We're going to hit you with more. We ain't stopping. As this train gets going, as a hyperinflation train gets going, we're doing more to keep you abreast so you can protect yourselves and your family and do the things that you need to do to thrive in the current state of economic troubles that we're in. Till next time, guys, this is Rob Keents with goldsilverpros.com.